Financial independence isn't a mystery. It starts with a simple plan you can start this month. In this video, we break down a practical, no-nonsense routine to manage money, invest better, and grow real wealth. If you want freedom from money stress, this plan is built for real people. We'll use one concrete, repeatable routine you can apply again and again. Think of it as a small toolkit you assemble and use year after year. First, we need a target. You have to know what number will give you calm money and options. That target is usually your annual spending multiplied by 25, the classic 25x rule. It grows from a simple idea: withdraw roughly 4% a year. Let me show a clear example. If you spend $2,000 each month, you spend $24,000 a year. Multiply by 25 and you get $600,000 as a rough FI target. This rule is not perfect. Taxes, changes in lifestyle, inflation, and investment returns can shift the number. The goal is to set a real target you can track and stay accountable to. Second, you must free cash by using a simple budget. This is not about torturing yourself with numbers, it's about seeing where your money goes. A straightforward approach is the 50-30-20 rule. Half your take-home goes to needs, a third to wants, and the rest to savings. If you want to speed up FI, you can raise the savings share to 30 or 40%. The key is automation. Pay yourself first by setting up automatic transfers the moment you get paid. Put money into an emergency fund first, then into retirement and investing accounts. Next, decide how to invest. Choose a simple, low-cost mix of broad market funds. A common starter is a total stock market fund plus a bond fund for safety. Keep it simple and stay with it. Automatic monthly contributions reduce the chance of spending the money before you save. Over time, small, consistent investments compound into real wealth. For many people, a reasonable starting split is 80-20 or 70-30 in favor of stocks when you are younger. As you get closer to your FI date, you can shift toward more bonds for less volatility, but don't get stuck chasing the perfect mix. The best plan is the one you actually follow. Low costs and consistent investing beat clever but risky tactics. Fees matter. A few tenths of a percent in expense ratio can add up to thousands over decades. Choose funds with low fees and avoid high commission products. An emergency fund is your safety net. Aim for 3 to 6 months of essential living costs. Keep this money in a liquid account so you don't have to sell investments at bad times. Tax planning is part of the plan. In countries with tax-advantaged accounts, use them for retirement savings. If you can, max out accounts like a 401k, IRA, or equivalent, and keep your investments tax-efficient. Another income lever is to increase earnings. Side gigs, upskilling, or asking for a raise can add fuel to the fire. The goal isn't to burn out, it's to create more room for savings and investment. If you want a practical start, pick one small habit to begin this week. For example, set up an automatic transfer of 5% or 10% of your take-home pay into investments. Over time, increase that amount as your income grows. The important part is consistency, not perfection. Rebalancing is the process of keeping your investment mix in line with your plan. You don't rebalance every week, you do it once a year or after a big move. A small trick is to set automatic rebalancing within your brokerage. This keeps you in line with your target without you watching the market every day. Be patient with the market. Downturns are uncomfortable, but they lower prices for future investments. Your mindset matters as much as the numbers. Financial independence is a long game, not a sprint. If you expect instant results, you will lose focus. Now, let's imagine a practical example you can copy. Two people, Mia and Noah, start by calculating their FI number and setting a monthly savings target. Mia spends about $3,000 per month and saves $600 right away through automatic transfers. Noah spends $4,000 and saves $1,000, but only after cutting some recurring costs. They both choose to invest in low-cost index funds and to keep deposits automatic. Over 5 years, Mia's smaller start grows steadily, while Noah's bigger start grows faster. If one of them loses a job, their emergency fund helps them ride it out. Both adjust their spending a bit, but they keep investing. At year 5, Mia reaches a funded amount to cover about 60% of her annual spending. Noah is closer to full FI and feels more secure. These stories show the plan in action. The steps are the same, only your numbers change. Next, what mistakes should you avoid? First, don't try to time the market or chase hot tips. Second, don't ignore fees or let them creep up over time. Third, don't skip the emergency fund. You need that cushion to stay on track. Fourth, Avoid excessive debt. High-interest debt can crush your progress. If you have debt, focus on paying it down before heavy investing. Fifth, stay humble. Markets go up and down, and your plan should survive both. Consistency beats speed when the path is long. Now about taxes again. Some people miss the tax benefits of saving in the right accounts. Learn what options exist in your country and use them to keep more of your money working. Another practical tip: automate more than you think you need. You want a system that works even when you forget. Do a yearly check of your numbers. Recalculate your FI target if your spending or family size changes. Keep learning. Read a book, listen to a podcast, or talk to a financial mentor. But don't get distracted by every new fancy method. Now, a quick reminder: financial independence is not about becoming rich, it's about options. More options mean you can choose work you enjoy or cut hours and still live well. The plan is practical because it starts with what you already earn. The steps fit into a normal week without needing a miracle paycheck. If you implement even a part of this, you will notice changes. Small wins build momentum and confidence to push further. The path is different for everyone, but the skeleton is the same. Get your numbers, automate, invest, protect, and grow your income. One thing I want you to remember: the goal is freedom, not deprivation. Freedom comes from security, and security comes from good habits. To close, I'll repeat the core steps in a simple sequence. Define your FI number, automate savings, invest in low-cost funds, protect with an emergency fund, and grow income. Then, review your plan yearly and adjust as life changes. That steady rhythm is what keeps FI within reach. If you want to start tonight, pick one action and do it. Set up a transfer to an investment account today and forget it for a year. If you enjoyed this, please hit like, subscribe for more simple, practical finance ideas, and leave a comment with your FI target or first habit you'll start. Let's help each other stay accountable and share concrete wins. Thank you for watching. If you found this helpful, consider applying one small step this week. Like this video, subscribe for more simple, practical finance ideas, and leave a comment with your FI target or first habit you'll start.